All right, let's talk about something that drives every single trader and investor crazy: financial news. We're going to build a framework today that helps you see past all those screaming headlines and actually understand what the market is really trying to tell you.
I mean, come on. We have all been there, right? You see this amazing news, a company is crushing it, you're absolutely sure the stock is about to take off like a rocket, and then it just falls off a cliff. It is so frustrating and it feels like it makes zero sense. But trust me, there's a very clear reason why this happens.
And this right here, this is the single most important idea you need to burn into your brain. The market doesn't trade the news itself, it trades the gap. The difference between what actually happened and what it thought was going to happen.
Okay, so let's get into the nitty-gritty. The very first step is just learning to read what the price is doing right after a piece of news drops. And believe it or not, there are some really simple, powerful formulas for this.
Think of this table as your secret decoder ring. Let's just look at that first one. We get great news, it's all positive, but the price does nothing. Or worse, it drifts down. The table calls this distribution. So what's happening? Well, it means the big players, the institutions, are using that good news as cover to quietly sell their shares to all the excited retail buyers. Now flip that. Look at the bottom. Terrible news comes out, but the price just refuses to fall. That's accumulation. The smart money is in there, quietly buying up all the shares from people who are panic selling.
Okay, so we've got the first piece of the puzzle down. We can read the immediate reaction. Now let's add the next and maybe the most crucial layer: understanding the difference between news the market saw coming a mile away and a complete, total surprise.
You know, most of the news that really shakes the market falls into one of these four buckets. It's kind of like a spectrum, right? You've got the huge stuff, like macroeconomic data and geopolitical events that affect literally everyone. And then it gets more and more specific, all the way down to a single company's earnings report, or even just a tweet from someone really influential.
So here's the deal. Expected news, like an interest rate hike that everyone and their brother knew was coming, is almost always priced in. It's old news before it's even news. The market's already adjusted for it. But the unexpected stuff, whoa, that's a market shock. That's what causes those huge violent moves, because it forces everyone to rethink everything, all at once.
Okay, theory is great, but let's make this real. There's no better way to see this whole expectation thing in action than with a major economic data release. So let's imagine the entire market is on the edge of its seat, just waiting for the new inflation numbers to drop. All the big banks, all the economists, they've all crunched their numbers. And the consensus, the magic number that everyone is watching and has already based their trades on, is exactly 3.0% inflation. And then, bam, the official report comes out, the number is 3.2%. Now, you and I might look at that and think, okay, 3.2, 3.0, it's pretty close. What's the big deal? But to the market, it is a massive deal. It's not just a number, it's a verdict. And the verdict is, this is worse than expected. And that slight miss is all that matters. It means the economic reality is different than what everyone had priced in, and you're going to see the market react negatively and fast. The number itself was almost irrelevant. It was its relationship to the expectation that was everything.
All right, so now we get how the market thinks. That's cool. But how do we actually use this to make smarter decisions instead of just getting whipsawed around? Let's build a practical toolkit.
I absolutely love this analogy because it's just so perfect. Think of it this way. The news is the engine. It's the gas, the catalyst, the thing that provides the power for a move. But your charts, your technical analysis, that's the map. It tells you which way the car was already pointing before you hit the gas.
So when a headline drops, you need to become a filter. And you run it through these three quick questions. First, the weight. How big of a deal is this, really? A Fed interest rate decision is like a boulder being dropped in a pond. A CEO's tweet? It's a pebble. Second, the context. What's the market mood? Is everyone bullish and buying everything, or are they terrified and selling? Good news in a fearful market often does nothing. And that leads to the third step, where you put it all together to figure out the most likely outcome.
And this right here is probably one of the biggest takeaways from this whole thing. You have to remember that big, long-lasting trends are driven by really deep things, like economic cycles. News is usually just the tailwind that makes it go faster, or the headwind that slows it down. It very, very rarely turns the whole ship around.
Okay, let's get into some pro-level stuff now, because knowing the theory is one thing, but avoiding the classic traps that snare 90% of traders when news breaks, well, that's where the money is.
This is the golden rule. Seriously, that first insane vertical spike or plunge you see the second the news hits, it is almost always a fake out. It's a trap designed to catch all the knee-jerk reactions and automated algorithms. It's usually not the real sustainable direction.
So what's the pro move? You do nothing. That's it. You just sit on your hands and wait. You let the dust settle. A lot of pros will wait at least an hour, sometimes even until the next day, to see where things really shake out after all that initial noise is gone. Patience is your superpower here.
Here's a fun one. You can actually use the mainstream media as your own personal contrarian indicator. When every single magazine cover and financial news channel is screaming about how it's a new paradigm and stocks can only go up, that's usually a pretty good sign the top is getting close. And when they're all predicting Armageddon, well, that's often when the best buying opportunities are born. And finally, we've got to be really clear about the difference between a simple data mess and a true market shock. We're not talking about a scheduled report here. We're talking about the bombshells, the stuff that comes out of nowhere and completely blindsides everyone. Think about a huge company like FTX collapsing overnight. These kinds of events don't just nudge the market. They pour jet fuel on whatever trend was already in place.
So there you have it, a complete framework for looking at financial news like a professional. You now know how to decode price action, how to focus on expectations over headlines, and how to avoid the most common traps. You basically have a brand new lens to see the market with.
And that's the real question, isn't it? The next time you see that breaking news alert flash across your screen, I want you to just take a breath and ask yourself, what was the market expecting and how does this change things? Answering that one question will make all the difference in the world.
Please subscribe and like.